Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Hasnan Asdiki. I'm from Management International Class A with name B1002245551. In here I will reading summary of management accounting assignment. The first chapter is capital decision making. The meaning, what is capital decision making? Capital decision making, also known as capital budgeting, is the process of analyzing a potential investment or project to determine if a company should pursue it. Capital budgeting is the process of evaluating and selecting long-term investment project or capital expenditure. It involves analyzing the potential profitability of project to determine which one are worth pursuing and allocating financial resources accordingly. Capital budgeting decisions are crucial for business as they involve significant financial commitment and can impact the company's future growth and profitability. The importance of capital decision making in financial planning. The first is efficient allocation of resources. That means business have limited capital, and capital budgeting ensure the resource and directly towards the investment with the highest potential return. The second, informed decision making by analyzing future cash flow and potential risk. Capital budgeting technique provide a data-driven approach to investment decision. And capital budgeting technique, net present value or NPV. NPV calculate the present value of expected cash inflow and outflow of the project. And the second, internal rate of return or IRR. IRR is the discount rate at which the present value of cash inflow equal the present value of cash outflow. And the last, payback period. The payback period is the time it takes for a project to recover its initial investment. The last feature of the capital decision making process. The first, long-term perspective. Capital budgeting focus on project with long-term implications such as investment in new facilities, equipment, or technologies. The second, risk and uncertainty. Investment projects are inherently risk, and capital budgeting helps in assessing and managing this risk through various techniques. The last, time value of money. Capital budgeting consider the time value of money, recognizing that a rupee that is worth more than a rupee in the future. And the next chapter, accounting responsibility center and transfer pricing. What is responsibility center? A responsibility center is a unit of an organization that is managed by a person who is responsible for its activities and result. The center have their own goals, staff, objective, policies, and procedure, and financial report. The type of responsibility center. The first one, cost center. A cost center is a department or a unit which supervises, allocated, segregates, and eliminates all sort of the costs related to a company. The cost center prime work in to check the cost of an organization and to limit the unwanted expenditure the company may acquire. The second, revenue center. The center is accountable for initiating and monitoring revenue. The third, profit center. It is a division or department of a company which operates for the calculation of profit in an organization. The last, investment center. The center is responsibility for both investment and revenue. The investment manager can control expenses, income, the fund investment in asset. And the purpose of measurement. The first, provide a good evaluation for past and future investment project individually and as a whole. The second, provide useful information for division managers and head office managers to make the right investment decision for the division and the company as a whole overall. The third, motivate division manager to always monitor the division asset, debt, and capital use as a basis for determining the amount of investment. And Transfer pricing. The definition is transfer price is the price charged when one segment of a company provides goods or services to another segment of the same companies. Three common approaches are used to set transfer price. The first one, negotiate the transfer price. Second, transfer at variable cost or full cost. The third, transfer at the market price. And negotiate transfer price results from discussion between the selling and buying deviants. Advantage of negotiate price. The first maintains the independence of division aligned with decentralization. The second, managers involved have a better understanding of cost and benefit, resulting in more informed decision. And evaluation of negotiate transfer pricing. A range of transfer price can result in higher overall profit for the company. And international aspect of transfer pricing focus on minimizing tax, duties, and exchange risk, and exchange the company standing in the global market and improve relationship with foreign government. The third chapter is inventory management, traditional versus just-in-time. The definition of inventory management involves overseeing the storage, control, and movement of goods throughout the supply chains. This includes receiving, storing, tracking, and distributing items. The key object and the main goals are to ensure optimal stock level, minimize cost accounting with storage and handling, prevent stock out and excess inventory, and meet customer demand effectively. The type of inventory, the first one is raw material, the second work in process, the third finishes good. And next, traditional inventory management principle. The first is system. Production is driven by forecast demand, with good being produced in anticipation of future sale. And the second main objective, maximize production output and inventory availability to meet any potential demand. And traditional inventory technique have a three inventory technique. The first is ABC analysis. Categorize inventory item based on their value and impact, focusing resource on high value item. The second is FIFO, first in, first out, assumes that the oldest inventory item are sold first, ensuring fresh product and minimizing spoilage. And the third lever, last in, first out, assume that the newest inventory item are sold first, impacting cost of goods sold and profit margins. The conclusion is traditional inventory management has evolved significantly, but it's still focused challenge in today's complex and dynamic business environment. Emerging technologies like AI, customization, and data analysis are transforming the way business manage inventory. The next, just-in-time. The definition of just-in-time is manufacturing is a demand pull system that requires goods to be pulled through the system by present demand rather than pushed through the system on a fixed schedule based on anticipated demand. And the basic feature of just-in-time, the first is minimal inventory level, the second demand pull production system, the third long-term supplier relationship, and the last cellular manufacturing and multi-skilled labor. And how to set up carrying costs. The just-in-time approach, the first is minimizing costs, second long-term contract, and third continuous replacement. In just-in-time limitation, the first is warm-up time. Initial compilation and executing may be slower as the system compile codes during runtime, affecting startup performance. And the second, increased memory consumption. Just-in-time compiler require additional memory to store compile, make machine code which may be problematic in memory constrained environment. And the fourth material is balance scorecard for perspective. What is balance scorecard? A balance scorecard is a strategy management performance metrics that a company can use to improve internal business operation and external result. It's a way for organization to focus on process that when combined can help them meet their financial goal. Who use balances scorecard or BSC? BSC were originally meant for profit company but were later adapted for non-profit organization and government agency. Currently, they are used in business and industry, government and non-profit in the US, Europe, Asia, and they are gaining wider acceptance in the Middle East and Africa. And balanced scorecard for perspective. The first financial perspective, and the second customer perspective, and third internal process perspective, and the last our organizational capacity perspective. Next, the 5 material chapter, the environmental cost management, how to measure and how to reduce. The definition: environmental cost management refers to the process of identifying, analyzing, and managing the costs associated with a company's environmental impact, compliance with environmental regulation, and sustainability initiative. The goal is to optimize financial performance while minimizing ecological harm and enhancing corporate responsibility. And how to measure environmental costs? The first is identify environmental cost category with like direct costs, indirect costs, and hidden costs. And the second, use environmental accounting system like active based costing or ABC, and material flow cost accounting and life cycle costing. And how to reduce environmental costs? The first one is optimize resource use, the second is reduce waste, and the third is adopting cleaner technology. And the last chapter, or the sixth chapter, is international issues in management accounting. And what is the role of management accounting in the international environment? Management accounting provides financial and business expertise. They must stay updated on global change in areas like politics, economic, and financial accounting rules of countries where the firm operates. And the second level of involvement in international trade, importing and exporting, wholly owned subsidiaries, and joint venture. And the third is foreign trade zone, area in the US considered outside US commerce for customs purpose. And the second goods in the zone are duty free until moved out, reducing costs like tariff and carrying costs. What's the key terms? The first is hedging. Hedging is using forward contract to manage currency risk. And the second, foreign trade zone. Foreign trade zone is duty-free zone to reduce costs. And the last, current risk management is managing risk from exchange rates fluctuation. Ethical issues in international business. Ethical dilemma arise due to differing cultural norms and laws, and company must balance local custom with their own ethical standard. The last examples including bribery, child labor, and insider trading. Foreign currency exchange, transaction risk of exchange rate change affecting cash transaction, economic risks, impact of exchange rate of the firm future cash flow, and the last translation risk, revolution of foreign subsidiaries financial into home currency. That's all from me. And wassalamualaikum warahmatullahi wabarakatuh.